Hi, I am Professor Milligan. Welcome to my weekly series, Wall Street Wednesdays. I record this series live every Wednesday from 1 to 2 p.m. Pacific Standard Time on my Instagram account at Professor Milligan. Welcome to join me there or listen to the recording here. Enjoy. Thanks. Was it 2 weeks ago I did a live cast on Instagram, live webcast, live stream, excuse me. And I posted my comments and some other things on the end of that video. Well, it was too long. I couldn't post it to the end of the video. So that video, I think, is like 35 or 40 minutes long. I think that last week's video is going to be about the same, 35, 40 minutes long. And what I do in these videos, I talk to you guys because I'm on Instagram Live. It kind of hampers me actually giving you visual aids and some other things. So I go and create a video. Usually it's a PowerPoint video, so I take a PowerPoint and create a video which gives you some actual examples and illustrations of what I'm talking about. So those take longer than I thought. Those take me about, they take me about a good day to get those up and running, so that's why I'm a little behind on those. But the reason why I'm telling you that is, if you go watch those videos, I literally give you visual examples and we talk about it and I show you what I'm working on and how I do it so you can actually see it. So today I'm going to actually show you guys or give you guys one of my strategies and kind of break it down. And then my plan is, again, like I do, is to actually, post this on YouTube, and then I'll also create another PowerPoint for that, which will explain all this. It's things that you can use right now, you can do right now to start putting some money in your pocket. Okay, so let me do a couple things first. Let me just review from last week. So last week we talked about, one of the things we always talk about is the market as a whole. And as you guys, I'm not sure if you saw today, the market was up most of the day, but slightly up. An interesting market. The Dow Jones was down a couple of points, fluctuating between being up and being down. Nasdaq, S&P and Nasdaq were up. S&P and Nasdaq are moving off the tech stocks. So the tech stocks moved those today. But what's interesting is you have the Dow Jones was down and ended up closing down 78 points. I think it was the final close. I can look at it here. It's 77.78 points, which actually was the low for the day. You're not seeing what I would call big follow through. Some stocks are going higher. There's, as we talked about before, there definitely is a disconnect between the stock market and what's going on with the economy. Let's see what else. Earlier this week, or was it last week? Can't remember now. Fed Chairman Powell and also Mnuchin were on, and they were talking to the politicians about what was going to happen, what they were doing, what they saw happening with the coronavirus, and how they're going to help the economy, and they're willing to do whatever it takes to keep the economy going. So that's what you're looking at. One of the things I keep telling you guys, and that hasn't changed, is that I'm still short the market. I haven't seen anything that's going to change my opinion on that. So, and if I do, I'll cover. But right now, I think right now I'm down a little bit. So I was even, now I'm down a little bit because the market went up a little bit today, S&P. But I'm real comfortable where I'm at. That's that. Give me a second, let me look here too. So I want to tell you about that. What else do I need to tell you about? So the market. Oh, last week also, from last week, I posted some charts. So I posted the charts that showed support and resistance, showed a descending triangle. And as we go through this week, several stocks are trading within that trading range, which I had told you about. They're trading at the top of their trading range. None of them have broken down, but they are at the top of their trading range. Several of the stocks that were in the descending triangle, usually, so let me explain this. When I call it a descending right triangle. On a right triangle, whether it's descending or ascending, what you see is the stock, the company is usually going to break to the right angle. So when I called it a descending right angle, it's because the right angle was on the bottom left-hand side, which meant that we should expect to see this descend. Now, I've had a few stocks that actually are going up higher, so that happens. But most of them are still within that trading range or still within that descending triangle. So I'm not surprised. Oh, let me give you my commodity report. So let me show you what commodities I found this week. Recommendation, long corn. Now I gotta confess, I brought corn. I brought some corn, went long corn. My position right now, corn has started to run for the last 2 days. My position I've been in for basically 2 days has doubled in value. You might think that one of the things I had told you was some of the positions I'll go into, some of the trades I do, I'm looking for multiples. I don't even think that corn is even close to being near the end of the move I'm looking for. This right now, the position I have, I have a position that goes out. I got to almost 2 months in this position, or will have, and I do expect that. I expect more than a double on this. I think that I could be looking at a 4 or 5 multiple return. The reason why I say that is because fundamentally corn is in a bullish market. So that's what's going on with corn. It's just in a bullish market. I am long corn. And as I said earlier, this is based on my commodity list, based on my fundamentals, not on technical. So on corn, the fundamentals gave me a buy for the last 3 weeks. My technicals gave me a buy, so I went in and it's working well. Also, I got a buy signal for the dollar, fundamental buy signal for the dollar, Kansas City wheat, and also red wheat. So I got those are my 4. Only had 4. On the short side, playing it for the price to drop. Fundamentally, I have the Aussie dollar, the euro, high-grade copper, yen, orange juice, and soybean. I tried my best last week to explain what's going on with soybean and corn. And the deal is that soybeans are running too. Now, soybeans are running. Soybeans actually are up more than corn is. And part of this has to do with what's going on with China. But again, that's the signal I have. And as I told you, I use 2 signals. I use a fundamental signal, I use a technical signal when it comes to me buying commodities. Corn gave me both the fundamental and technical. To give you a prime example, soybeans fundamentally is giving me a short, technically it's giving me a long. When that happens, I just back off. I don't do either trade. So those are the commodities I'm looking at. Those are the commodities I'm in. Again, like I said, I plan on being in corn. I'm not telling you guys to go out and buy corn. It's risky. But again, those who've been around me have kind of heard me speak know that if I'm in corn, you know that my position is hedged. So my downside is limited. I've limited my downside risk, and I'm still long corn. All right, so that's my commodities. And by the way, I guess I should tell you, one of the things that happened with corn is that yesterday, I believe it was yesterday, day before yesterday, the crop report came out. So the crop report comes out. It's where the USDA goes around and will go on farms. They'll talk to farmers. They'll look at the crops, and they'll give a report on what the crop's going to do. What was interesting on this last report is that they were expecting farmers to plant about 1.8 million less acres of corn. Well, when the report came out, it looks like, and what came out was that farmers are planting 5 million less acres of corn. So real simple, economics 101. Demand stays the same, supply goes down, price is going up. It's just that simple. That's what the fundamentals are telling me. And then, like I said, my technicals gave me a buy. So combining those two, I went long corn. And as you guys know, I've been talking about that for the last 2 or 3 weeks. So no big surprise there. All right, so you got my comments on corn. You got my comments on the commodities. Wheat looks really strong. The wheat looked really strong. Dollar looks really strong. The one thing I'll tell you guys, and just remind you guys, and some of you heard me say this, when there's financial turmoil anywhere in the world, anywhere, there's a flight to quality. A flight to quality means they're going to liquidate those investments and move to the sidelines. The way they move to the sidelines is they buy treasury bills. That's a flight to quality. So there's a gap in this. So let me explain the gap. The gap is this. If you're a businessman, investor in Europe, and you decide that things aren't going well, and you want to go to cash, you move to the sidelines because of this whole financial debacle. You move the cash. You want to move. You're selling your securities. You want to move the cash. You want to park it in the safest place in the world. You're going to buy U.S. Treasuries. But here's what you need to understand. In order for that investor to buy U.S. Treasuries, here's the process. 1, They got to sell the security wherever they're at in the world. 2, they have to take whatever currency they have. If this is Europe, they're in the euro. If this is over in Japan, they're dealing with the yen, the yuan, whatever country they're in. They have to sell their country's currency and buy the dollar. All right? And then they take the money that they buy the dollar with and they buy treasuries. So here's what happens. As a group, I'm not saying that China, Japan is in a major financial problem, but let's, for my example, say that Japan's having a major financial problem. We know they're battling zero interest rates, negative rates, but let's say that a new financial disaster erupts and it's hitting in Japan. All right, Japan. They're going to sell the yen and buy the dollar. As a group, if they're selling the yen's going to go down in value, the dollar's going to go up. So one of the reasons why you might be seeing the dollar strengthening and you see this fundamental is because globally you might see pressure coming from investors who are looking to basically have a flight to quality. And if that happens, they're going to basically buy the dollar and then buy treasury bills. When that happens, you'll see a run in the dollar. The dollar's going to run. It always does. How long it lasts? Don't know. But we saw it in 2008. You see it all the time. So anytime there's a financial, you saw it back in March when the coronavirus hit. Keep that in mind. Keep thinking about that. And that's one of the reasons why if big, not a big if, more when this market cracks, or if it does crack, or when it does crack, whether it be tomorrow or 6 months or a year from now, if the market cracks and we go into a real bear market, one of the things you want to look at is to be long the dollar. Flight to quality. Okay, so we got the currencies down. I talked about the dollar, talked about the grains. We just ended the second quarter of 2020. What that means for us is now that we ended the second quarter of 2020, today was the first day of the third quarter. But what it means is that in a couple of weeks, we will be in earnings season. To tell you how I think about earnings season and what my feelings are about earnings season, when I was actively running my hedge fund during earnings seasons, my wife was not allowed to call me in the office. She couldn't pick up the phone and call me. And if she did, I wouldn't talk. This is money making time. I'm going to go into a strategy on how to prepare and how to work with earnings. I'll do that next week because I can't do earnings and do the secondary public offering, which is some money to be made there right now. So I'll do, as I say, talk about secondary public offerings today, but next week, I should be able to finish the secondary public offerings information today, and next week I'll actually start talking about how you guys can prepare for earnings season. So you want to prepare for it, you want to start looking. It's money making time, whether the earnings are good or bad. Again, make sure you understand how to be short, how to be long, what it means to be short, what it means to be long. But we're rolling at the earnings season and it's going to be a money-making time. One of your peers asked me to look at a stock for them. Symbols WKHS. Don't know much about the company WKHS. Let me say it again, WKHS. I don't know much about the company. I'm looking at the chart on it. The stock about a month, 6 weeks ago. Oh, I take that back. Not even 6 weeks ago. A week ago. I'm sorry, I'm looking at a daily chart. I thought it was a weekly chart. So within the last 2 weeks, the stock has run from $5 a share to $20 a share. So those of you in front of a monitor, plug it in, symbols WKHS. What you'll see is if you really look at this, if you look at the chart, the breakout came on the move through $5. On the move through $5, volume looks like about 3 to 4 times the average daily volume. So the move was through 5 that day. The next day there was a gap, so a gap that looked like it closed at 6 and opened up at 7. And from there it's done nothing but go straight up, almost parabolic. The question was, would I buy this stock? And the answer is no. You missed that train. If the stock went from $5 to $20 in a week, it increased fourfold, you missed that train. I don't know what's going on with the company. I don't know if it was a merger. I don't know, a takeover announced. I don't know if they're pharmaceutical with some type of new drug. I don't know what's going on with the company, but I do know that just based on technicals, I wouldn't touch it now. Again, we talked about this a little bit when I talked about the Fibonacci's, the fibs. This stock literally ran from $5 to $20, and there's one pullback in there with several gaps. What this means, from 5 to 20 is a 15-point move. The fibs means I would be looking for this stock to pull back at least $8 to $9. So I would expect it to pull back to the $12, $11, $12 range. The other thing that's interesting about that is that at between $10 and $11, $10, $11, there's a gap. So usually they'll fill that gap. I would, if I was in this one, I wouldn't buy it here because I think there's going to be a pullback, unless of course there's some corporate event that's going to stop it from pulling back, like a takeover offer. Two is that you missed this train. The breakout was at $5, and now that you missed it, I pay $5. I'd pay $6, maybe $7, but no more than that, just because you missed it. So this kind of reminds me of what I tell you guys, and that is, if you're not sure where to shop for stocks, one of the places you can shop is the all-time high list. I keep telling you that. Go look at these stocks that are at their all-time highs. Now, this stock went to its all-time high a week ago on that move through $5 on that volume. So it told you what was going on. It gave you a flashing light to say, hey, look at me. I don't think anyone who's in the stock thought it was going to run from 5 to 20. But again, I don't know what the circumstances are. But again, just to repeat, I know I'm redundant. I would expect a pullback on this, unless, of course, they've got a takeover offer. But this is just from natural market events. I expect a pullback, just pure profit taking. The fibs, I'd expect it to pull back to that $10 range, $10, $11 range. I wouldn't be surprised. And for those, again, you missed the breakout. The breakout happened at $5 a share. That's what the breakout was. Okay, so that's my take on that stock. Just to repeat to you guys again, if you have anything you want me to look at, you have any questions, any concerns, feel free to, message me, inbox me with the message, and I'll either directly message you back, or I'll talk about it right during Wall Street Wednesday. This is what I do. Now let's talk about a money-making strategy. I'm going to have to explain this. Some of you might know it, some of you don't, but I'm going to explain it. We're going to look to actually trade in the secondary public offerings, seasoned public offerings. I know all of you guys have heard the term IPO, initial public offering. That's when the stock goes public. It's funny, I was having this conversation with some of my students and my daughter just yesterday. So a company goes public. A lot of times when these companies go public, most cases, the insiders, the VCs, and the private equity firms usually don't sell at the IPO level. What they'll typically do is anywhere from 3 months, 6 months, a year later, that company that went public will come back to the marketplace, what's known as a seasoned public offering. And what that means is it's where the insiders, senior management, VCs, private equity firms, will sell their stock to the market in a secondary offering, which is called a seasoned offering. The reason why they call it seasoned is because they're issuing more of the same IPO stock, but they're issuing it now closer to where the market is, or market price. So let me say it again. What happens here is the company went public, and a lot of times when they go public, they don't offer all the shares. They basically bring the company public to bring liquidity into the stock to help them raise capital. The other thing is the insiders typically don't sell their stock at the IPO level. By the way, if you're ever in a stock, IPO, or looking at an IPO, and you find out that the insiders, senior management, and the VCs and private equity guys are selling all their stock at the IPO, my advice to you is don't buy the IPO. And if you see it and I don't, message me, call me, because no question, I'll get short that IPO stock as soon as I can. Because if the insiders, senior management, and the private equity guys and the VC guys are selling their stock, they know more about the company than you and I do. They work there every day. They're in there. All right. If they're selling their stock and don't want to own it, why would I want to own it? Now, when it comes to secondary offerings, again, there's two types. There's the shelf offering, and then there's also just a regular, what we call basically secondary public offering, SPO. Now, a shelf offering is when the corporation decides that they're going to do a secondary offering. They're going to raise some capital. And by the way, it can be stocks, preferred stock, common stock, and bonds. They can do all three or they can do one. So on the shelf offering, what they do is they get all the paperwork together. Key, you understand this. All the paperwork is done. Because to bring a company public or do a secondary offering usually takes anywhere from 30 to 60 days. And a lot can happen in the market in 30, 60 days. So by doing this shelf offering, they have up to 3 years to do the offering. So they can file all the paperwork and leave it on the shelf. So what happens? They leave it on the shelf, and I'll give you a prime example. There's one that's coming tonight for tomorrow. It's been on the shelf for a couple of months now. No, I take that back. They announced it. They put it on the shelf. I think it's been on the shelf for a couple of months now, a couple of weeks. All right. And when they bring it, they're going to basically pick up the phone, call institutional investors, tell them that the company's doing a secondary offering. They call them a shelf offering, a layoff. Do you want me? And this deal will come tonight and start trading first thing tomorrow morning. Now, how do we make money off this? On a shelf offering. Well, two things. IPO in the secondary market works is when they announce a secondary offering in general, the investment bankers typically will bring the price of the stock down. The reason the stock price comes down is two reasons. One is there's no natural buying as much anymore because investors like you and I know I can just buy secondary stock, so why buy IPO stock? I can buy secondary stock with no commission. The other thing that we know is that because they're about to drop 2, 3, 5, 10 million shares on the market, the price is going to come down. So one of the things that you'll find out when a company does a secondary shelf offering, when they just lay it on the public, they're going to do it at a certain price. So I'm making up numbers now. Let's say they do the stock closed at 25 and they're doing the secondary offering. The shelf offering is done and priced a little bit in the hole at 24. That 24 is our number. What this means is, one, if you got some of this secondary stock on the shelf offering, you own it at 24. 24 is our number. If this stock breaks below 24, which they can do, I'm probably going to short it looking for 2, 3, 4 points. Let me say it again. If they drop this stock, all this stock on the market at one time, the price is going to come down. I'm going to play it short for maybe 2 or 3 points, 4 points. That's the first thing I'm going to do. I'm not being greedy here. I just know that when you drop stock on the market like that, when you lose huge blocks and the market wasn't ready for it, the stock's going to come down. Now, you got that. Second thing, I'm looking for 2 or 3 points on that. If I get it, great. If I don't, I'll cover. The other thing, though, is that when this stock, and again, I've looked at the company now, if this stock goes back through that 24 price, I'm probably going to go long. I'm going to buy it. Understand, this was probably a really good IPO. When I mean good, a stock that was priced at $10 or $20 a share that now is trading at $50, $60, $70 a share. I'm looking at one company right now on my monitor that they went public 6 months ago. Bear with me a second, I got to find it. 6 months ago, they went public. I can actually tell you they went public. They went public back in December. And the stock was priced in the 20s, went public, and today it's trading at $95 a share. So virtually, 2 quarters of trading in the stock, including what happened in, back in March, and the stock's trading at basically $90 a share. They did a secondary offering. They dropped it on the market at $74 a share. All right, they did it at $74 a share. The stock went through that 74 price, went to 80, and from 80 to 90. All that in 2 weeks. That's what you can find when these secondaries come. So now the IPO was a successful IPO. Stock was priced at 22, opened up the first day at 35, went as high as 40. Successful IPO. Real successful IPO. All right. These are the things we look at. When these companies go public, they don't raise all that capital at one time. They just raise enough capital to bring liquidity into the stock. So I'm going to repeat all this again. When you find a shelf offering, which means that they basically do it, they literally, you'll find out today, during market hours today, that if you're lucky, maybe today, but most likely you're going to find out after the market closes. So after the market closes, hey Brandon, what's up? Double Y. After the market closes, I just saw one of my former students. I nicknamed him the Economist, so you guys know who the Economist is. Oh, there's the other one, Gregory Pex, Franco Pex. So anyway, you guys know I give nicknames to everybody, so if you're around me too long, you're going to get a nickname. When this shelf offering is announced, literally, when they say we're going to do it, they'll announce it after the close of business today, and it'll start trading tomorrow on the opening. Again, if they price it and it breaks that offering price, that syndicate bid, you want to get short the stock. When it goes back up through that syndicate bid, you want to be long the stock. That's basically how it works. That was a shelf offering. Here's where you can make basically a lot of money. Now the company announces they're going to do a secondary offering. They hire the investment bankers. The investment bankers do a road show, which means they travel around the country, telling everybody how wonderful it is. It's not a big deal. They do this show, but not a big road show. So what happens is this. They announce a secondary offering. The investment bankers and senior management are going to go out and talk about the company to investors. But here's what we need to understand. The investment bankers, when they do a secondary offering, the investment bankers want to go into the deal short. So when that deal's announced over the next 2, 3 days, 4 days, week, the investment bankers are going to start bringing that price of that stock down, shorting it to a major support level. That's typically what they do. Now they do it for 2 reasons. One, they're getting short so they can help support the stock when they do the offering. And what I mean by support it is when they sell it to the public and some of the people in the public turn around and start selling the stock, the investment banker who's short is going to use that stock to cover. So we're going to do the same thing the investment bankers do. When we find out, we want to find out as soon as they make that announcement that they're going to do a secondary offering, but it's for 2 or 3 or 4 a week later. It's not a shelf offering. We know the investment bankers are going to get short. I'm going to get short right with them. They're getting short. I'm getting short. I'm going down with them. When it gets to what I think is support, which most likely is where they're going to price it, I'm going to cover my short position. The other reason why the stock comes down to here is on IPOs and secondary offerings like this, the investment bankers will contact the institutional investors and ask them what do they want to pay for the stock. And the institutional investors, of course, want to buy it at a discount. So the institutional investors, which Wall Street knows already, they're going to buy the stock at a 1, 2, 5% discount to where it's currently trading at. And a lot of times that's going to bring you to support level. So the investment bankers are going to bring that stock down to support level. At support level, the day of the deal is typically when I'm going to cover. I'm going to cover. Now, once the secondary offering, the season offering is done, let's pick a price. Let's say it's done at $70. Once again, that 70 is a key number for us. If it breaks 70, I probably will stay short. All right? It might come down 70, 69. I'll stay short. Hopefully it's not in bad shape. Once they digest all that stock and it's below 70, if it goes back up through that syndicate price, I'm a buyer. I am a buyer. Now, in the case of the company I was just telling you about earlier that they did the secondary layoff at 74, well, it ran through that 74, ran through 80, and went to 90, like I said, $91 a share, which is basically right near its all-time high. I'm looking at another one. I'm looking at a couple other ones here. They haven't had the move yet. So what do I mean by that? They were hot IPOs that did extremely well. And then they did a secondary offering. And after they announced the secondary offering, the stock pulled back a little bit. And then we're waiting for it to go back through. Now, one of my former students said about a month ago that I was trading at 10. He brought it at 925. That's when the offering was announced at 925. So Franco, did you make money or did you lose money? I'm not sure. I'll take a look at it. The only thing I'll say is just make sure you're not buying units. You know, I'm not crazy about those units. So I see you have, it looks like you might have units. I don't trade the units. I want to trade the stock. All right. So again, that's how it works. So let me give you some examples. And I'm actually going to put this, like I said, I'll post this. I'll post this. I'll post my comments again. You know, give me a week, but I'll post them on on YouTube at Professor Milligan. XP, symbol is XP. XP went public at $27 a share. Stock opened up for trading at $35 a share. Had a pullback in March like everyone else did. They announced that they're doing a secondary offering. The secondary offering is due sometime I think it's due tonight. I'm not sure where they price it at or going to price it at, but you can see where last week the stock was trading at $45 a share, pulled back to 43 today, closed at 43.44. But you can see where they pulled it back to support right there at the 43 level. I wouldn't be surprised to see the stock priced at 43. If it doesn't hold the 43 pricing, maybe you short a little bit, but I wouldn't short much. But I tell you what, when it finally does digest all the stock and work back through 43 or wherever it's priced at, I'd be a buyer on the move through that pricing, looking for the stock to trade. If the market holds up, again, always if the market holds up, trade up to that $45 then $50 price. And it should do it relatively quickly. So that's how this works. Let's see who else I can pull up here. DraftKings. DraftKings did a secondary, looks like about a week, maybe 2 weeks ago. They did a secondary offering. Wherever they did the offering at, the stock is lower from there. So the stock has pulled down to the bottom of a trading range. It basically, as I taught you last week, it's broken the bottom of the near-term trading range and went to a second support trading range and then bounced off of there. So my comment to you guys is this. On DraftKings, if DraftKings moves back up through the pricing, and I don't know where it was priced at. I'll have to look. But if it moves back up through, I think it was priced at 33. So if DraftKings moves back up through that 33 price, I'd be a buyer on DraftKings moving up from 33. And I would expect it to challenge its all-time high around 42, 43. So that's what I would expect with DraftKings. The thing I guess I want you guys to realize is that somebody said DraftKings is going to the moon. Well, I don't know if it's going to the moon, but I know one thing. On the move through 33, where the secondary was priced, and again, I'll check on that, but the move through 33, and by the way, on these moves, I know I've taught you well. On these moves, I'm not looking at the volume as much. And the reason why I'm not looking at volume because I understand what just happened. I understand that, and I'm not sure. On DraftKings, I think it was, DraftKings did what? DraftKings just dropped 40 million shares. I take that back. It was at $40. DraftKings just dropped 40 million shares at $40 on the market. All right? That's what they just did. So for me, the move through 40 is where you want to be. So you see DraftKings go through 40. When it goes through 40, I'd be a buyer. I wouldn't wait for volume. Whatever volume is going to show up, it's going to show up. But the move through 40 is where I'd be. And again, the only thing that's slowing DraftKings down, the slow DraftKings down was they decided to go out and raise 40, issue 40 million shares at $40. So you do the math. There's two types of secondaries. There's the shelf offering. Shelf offerings, they don't give you a chance to get short the stock ahead of the deal. On the shelf offering, they're just going to bring the deal to the market. They're going to drop it on the market. Most likely, whatever price they drop it at, I'm telling you that you could probably short it on the opening because most likely it's going to go down. Now, the other thing to look at when you look at this, though, is how good is the company? A few months back, Ring Technology, RNG. Ring did a secondary offering. I believe it was, I got so many numbers in my head, I can't remember exactly. I believe it was around the 170, 160 mark. Brought the stock after the secondary offering. It ran 20, 25 points, I think, for me. Then it pulled back. Make a long story short, the stock now is trading at 270, 260 in that range. These secondary, when these companies go public, I gotta explain this. When these companies go public, insiders typically do not sell their stock. Insiders hold their stock. The reason why they hold their stock is they know what the numbers are. They know what the earnings are going to be for the next year. They know what the stock should be trading at. They know better than you and I where the stock is going. If the market holds up, that's always the caveat. We need a flat to up market. Once this company goes public and it trades higher, boom, goes higher and higher. Even the ones that don't go higher, 2, 3, 4 months later, they're coming back to the marketplace with a seasoned offering. They're now going to sell that stock that they own that they did not sell at the IPO level. And again, on one company I told you about, stock was priced at 22. They did the secondary offering in the 70s. DraftKings was priced at, if I remember correctly, DraftKings I think was priced at $10 or $12 a share. And DraftKings right now is trading at $34 a share, been as high as 44. And we're talking about basically what, 3 months, including March, when the market pulled back. It was a successful IPO and the company's doing well, and they came back to the marketplace and they raised a lot more money on the second round. That's another opportunity for us to get in. It's a good company doing really well. They dropped 40 million shares on the market at $40. All right, institutions, all that. They sucked it all up. It put pressure on the stock near term. It always does. Use this as an opportunity to buy it. Look for the bounce on the move back through the 40. And, if it goes through the 40 and goes through the 44, which is all-time high, look for the stock to go even higher. This doesn't take long. We're talking about this all should happen in a matter of 2 to 3 weeks. Let me give you a couple of websites. P-R-O, Edgar-online.com. Repeat, pro.edgar, EDGAR-online.com. The other one now is Nasdaq, NASDAQ.com. You can go to these two sites and get information on secondary public offerings as well as IPOs. Edgar is a government website that's for free that will give you all legal documents filed by all corporations. So you're going in there looking for the secondary offerings. I'll explain to you, if you go in there and you get lost, don't worry about it. You can work your way and look around. There's also other companies out there that you can pay for services that will email you lists of companies that are about to go public, companies that are about to do a secondary offering, the whole thing. If you're interested, again, those companies are going to charge you. You can get it for free. Some of you, as you know, I get that information for free myself. So some of you know I already get that information. You can get it, you can pay for it, you can get it free. I gave you 2 free websites. I also pay for that information. Tesla. I have not looked at the stock. I do follow and read up on the company, new products, new services. I know that right now they're saying Tesla is Tesla has a higher market value than Toyota. I don't have an answer for you on the stock. As people have heard me talk about Tesla, and I've talked about Tesla in the past. Oh, Troy, thank you for putting that up for me. I appreciate that. So Troy's put up, it's pro.edgar-online.com and nasdaq.com. When you go on nasdaq.com, you want to go into, I'm doing it now as we speak so I can make sure I give you the right names. So when you go into nasdaq.com, you want to go into the market activity section. And in the market activity section, if you pan down, you'll see that there's a IPO, and there's also IPO calendar and also a SPO, which stands for Secondary Public Offering Calendar. So you can click on either one of those and I'll take you to the calendar and show you what's going on with those. I highly recommend that you guys just go on there and play around a little bit and search. And the reason why I say that is because there's a wealth of information in there. And again, for us, we're not into just grabbing data information to grab data information. As I always tell you guys, when you grab data information, ask yourself, how can I make money off this? So that's what we're doing. I'm showing you where to get this information from. I'm telling you how to use it. But again, it's how we're going to make money off the data. So that's what we're using this for. Tesla. I'm at a loss with Tesla. If the fundamentals aren't there, I mean, the fundamentals just aren't there. You're literally paying up for something that hasn't. You're paying up for something that hasn't shown it can actually justify that valuation and price, or even close to it. Tesla right now, the way it's trading is trading in price for perfection. And I don't know if perfection is going to show up there. And the reason why I say that is that, and you guys have noticed, they've had problems with manufacturing, problems with getting the product out. The products had problems. Love the car, love the product. I'm just saying that there's been problems. And one of the reasons why Tesla's running is because it's first to market, but there is competition. So I guess I would say this to you. If you're going to go into Tesla, invest in Tesla, I would start small. I would add to it only when it was going up. And I'd probably be real quick to take profits. I just, or if you're gonna hold it long term, I'd hold it long term with a small position. That's what I would do. If you definitely want to be in it, I'd be in that. And if the stock starts to confirm itself and start to trade well, I'm talking about over time, then I would add to my position. But there's no way I would take a full position. Or the other thing I would do is I'd trade it. I really would. Now, I don't trade nearly as much as I used to. I'm just not into it. I just don't have the energy to trade. Trading takes a lot of energy. So I'm more now of a buy, hold. So I guess you would call me a momentum trader, one. And in some cases, which I had said earlier to you guys, you guys heard me talk about my corn position. I'm in that corn position for 2 months. And if things go well and I keep looking at it, I'll stay in that corn position for longer than that. So I'm not looking to trade. My strategy more is looking for long-term. I shouldn't say long-term. My strategy is looking for bigger moves. And big moves take time. Big moves don't happen in a week, 2 weeks, unless there's some major corporate event that's forcing that to happen. Most of my positions, again, I have no problem being in long-term. But again, as I told you guys, I'm not buying or trading a stock looking for 2 or 3%. All right, I'm looking for a lot more than that. Now, I just gave you a short-term trading strategy on the secondary market, secondary public offerings. But again, in the case of Ring, I'm telling you, I stayed in Ring for a while. So a lot of times when you look at these secondary public offerings and you get that opportunity, you get in there and you get a good price and the company's doing really well, you might want to stay with it. Don't trade. Trading it takes a lot more energy. And if you're trading, the challenge, don't get me wrong, I'm not against trading. I traded. I have no problem trading. I probably traded more than all you guys on this call put together. So I'm not against trading. Don't get me wrong. I made a lot of money trading. All I'm saying to you is it takes a lot of energy. And what I also have noticed, and this is one of the things I learned, that several of those stocks that I traded as a younger man, if I had just held on to those several stocks, I wouldn't be on this call right now. I wouldn't be talking to you guys. I'm more of a momentum trader, more of a position trader. So, and again, as I said to you, I'm looking for multiples. And I know I got a couple of my former students up here, and some of you guys have traded and made multiples on your money. So you know what I'm talking about. You know that is possible and doable in the markets. The thing that you need is volatility. Okay, let me do this real quick. I told you my positions. I've got 10 minutes left. I answered Tesla. So again, I would trade Tesla. If I was going long term, I'd buy a small position and look to add to it over time. Question, do I day trade? I got to be careful I say this. The answer is no, I don't day trade. Have I brought and sold a stock in the same day? The answer is yes. I've done it a number of times. So here's the deal with me. I don't day trade, But I am a stickler for if a stock goes against me for 10% or more, at 10%, I'm selling. And it's on a new position, unless I've been in the stock for several months, several weeks with a big profit. But if I just enter a position, if I brought a stock this morning and that stock went down 10% during the day, I'm gone. I do not hold stocks. That's how I trade. I don't hold losers. I don't take big losses. The first time I put a trade on, if it drops by a certain price, I'm out. If it does what I think it's going to do and trades well, and I got in at the right time, the right place, then I'm going to sit with it. And I'll sit with it as long as it's working in my favor. One of the things I highly recommend to you guys, and I said this before, is one, have a journal. Make sure you write in a journal. 2, study your trades. Why did it work? Why did it work? Why didn't it work? Understand what's working for you and what's not working for you. Don't be a day trader because you hear people that say day trading. And again, I'm not trying to put day traders down. I know a number of guys that were day traders. Most day traders I know have not done well, but that doesn't mean you won't do well. All I'm saying is it's not for me. It's a lot of energy. And the challenge that you run with day trading is, and a lot of times you're trading for, 10 cents, 20 cents, 50 cents, $1. The problem you have is how much are you going to lose when you're wrong. So if you're making $1 when you're right and you're losing $1 when you're wrong, but you also have to take into account commissions and fees and other things, you got to be right. You got to be right 75, 80% of the time to make a decent amount of money if you're only making $1 and you lose $1 when you're wrong. So in my case, I might lose $1, but when I'm right, I'm making $2, $3, $4. That's what I want you guys to understand. If I'm down 10%, I cut my loss at 10%. But when I'm right, I make 30, 40% in a week or 2 weeks, then I'm okay. And one of the reasons why you can make 30 or 40% in 2 or 3 days is because the stock is moving fast and you're on margin. Christian also likes DraftKings. Christian's a former student of mine. Good to see you, Christian. And then I had another one here that says, what's this one saying? Need a lot more discipline, day trading, especially derivatives. Yeah, you need if you're day trading, one is you need a lot of discipline. 2, you're sitting in front of the screen. 3 is, which I always tell students, you can sit there and stare at the screen all you want, but you have no control over these prices when they move up and down. Most of your work for me is done, is not done in the market. It's done, done with other things, and I just sit there and put a trade on and let it go. It's like the Army, hurry up and wait. The other thing too with day trading is that you're competing against Wall Street. You're competing against the market makers or the specialists that work for Goldman Sachs, that work for Morgan Stanley, that work for Merrill Lynch. You're competing against them. And the deal is that my experience has been, again, and I've been down on Wall Street, literally worked on Wall Street, been down there and saw the specialists screw over over the day traders. I've seen the specialists move markets. I've seen it firsthand. And so when you see that, I'm not saying day trading doesn't work. I'm just saying that most people don't have the temperament to handle it. If I had $100,000 to invest, would I invest it? Great question. Here's what I tell here's what I say to you guys who are just starting out trading. If you have 100 grand, I'm smiling as I say it. I taught one of my college classmates trading. He literally approached me. He found out what I was doing. We're friends. And he said, Mike, I want to trade the market too. Show me how to do it. I asked him how much he started. He said, well, Mike, I have 100 grand. I said, great. I said, here's the advice to start with. Same advice that was given to me, same advice I'm giving to him. I gave him, I'm giving to you. Act like you only have 10 grand. Act like you only have 2 grand. You go through a learning curve. All of us go through a learning curve. If you think that you can just listen to me, read a book, and go out there and you're going to be a good trader already, you're kidding yourself. You're going to lose money. I lost money. So my first year of me acting, this was after being a broker, being licensed, being a broker. My first year of trading my account, I was prepared to break even. If I would have broke even, that would have been a great year as far as I was concerned. Now, I ended up making a lot more than breaking even, but that was my mentality. And I lost a lot of money. I made a lot of mistakes. So one of the things I say to you guys is, if you start trading, start with a couple of grand, 2 or 3 grand, 4 grand. Why do I say that? One, there's a learning curve. Two, you have no idea. You might have an idea what you're doing, but you're not experienced at it yet. Allow yourself the room to make mistakes and lose money. Allow that. So trade like you only have 2 or 3 grand. Learn your craft. You'll step up in size. I remember my first when I first started trading, if I made $1,000 in a week, I'm telling you, I'd come home and me and my wife Sherry would go out and have dinner. We'd have a party. A couple of months later, I'd come home and she'd say, "How was work?" I said, "I made $1 grand, lost $1 grand." And it's all relative. I stepped up as I became more comfortable and had a better idea of what I was doing. I stepped up my trading. I stepped up the size of my volume. You only can trade the size that you're comfortable with. I don't care how much money you have. If you're comfortable with 100 grand in the market, that's fine. Then you're cool. If you have 100 grand, but you put 2 grand in the market and you can't sleep tonight because you're so worried about losing that 2 grand, then I'm telling you, then you're in the wrong. You shouldn't be doing this. One. And two is, I don't care how much money you have, you need to trade a lot smaller. I mean, I'm thinking about guys I worked with on trading desks that had, I'm thinking about one guy had a portfolio with a couple of $1 million in it. And he would trade blocks of 100 shares. That's all he would do, 100 shares. In this case, the size is what's comfortable for you. I'm getting a question on earnings. Next Wednesday, I promise next Wednesday, we're going into earnings season. It's time for me to actually start helping you guys understand how to trade earnings and what to do with earnings. So the one thing I'll say to you ahead of next week is that we're going into earnings season. One, you should have a list of stocks and companies that you like that we need to track and see what's going on with their earnings. All right? Let me say it again. I need this is for you, not me. I need you to go out and find a list of stocks that you're interested in buying, that you think you can make some money in, and earnings season's coming up, and I'll show you how to analyze these stocks going into the earnings, how to analyze them during the earnings, and what to expect after the earnings. As I had said earlier, this is money-making time for me. Earnings season is where I make money. You're going to make money. You have a major corporate event coming up, which is earnings. Earnings drive the market. Earnings drive stocks up. Earnings can also drive stocks down. So we're going to use earnings season to go out here and make us some money. All right. I'm running out of time. So again, let me first and foremost, thank you for attending and listening to me ramble. I do appreciate all your questions and concerns. I will look into them. I will answer them. I'm basically have a minute left in time. The other thing I'm going to say to you guys is this. Please follow me on YouTube, Professor Milligan. I'll give you a prime example. I'm going to take today's today's conversation. I'm going to post it on my YouTube page. I'm going to come right behind that and post probably a 20, 30, 40-minute video of me actually giving visual examples of what we talked about today in more detail. And I'll post that also. So that way you can see it. So keep track. I'll post them. You can see it. And other than that, I am done for now. I want to, again, thank you all for coming. Someone's asking about Kanye West and Gap. Kanye West is not going to save Gap. JCPenney's. Gap and JCPenney's both. I can't go into it now. Literally, I'm running out of time. So I need to sign off. Once again, thank you. Keep following me, and I promise you I'll answer questions. And accounting's not a good major. Take care, guys. Thanks for supporting me and following me. Thank you so much.